Here's an interesting note from Buffett on the concept of opportunity cost in his 1959 letter recapping his 1958 performance. He talks about as follows. So that you may better understand our method of operation, I think it would be well to review a specific activity of 1958. Last year, I referred to our largest holding, which comprised 10 to 20% of the assets of the various partnerships. I pointed out that it was in our interest to have this stock decline or to remain relatively steady so that we could acquire an even larger position, and that for this reason, such a security would probably hold back our comparative performance in a bull market. This stock was the Commonwealth Trust Company of Union City, New Jersey. At the time we started to purchase the stock, it had an intrinsic value of $125 per share, computed on a conservative basis. However, for good reasons, it paid no cash dividend at all, despite the earnings of about $10 per share, which was largely responsible for a depressed price of about $50 per share. So here we had a very well-managed bank with substantial earnings power selling at a large discount from intrinsic value. Management was friendly to us as new stockholders, and risk of any ultimate loss seemed minimal. Commonwealth was 25.5% owned by a larger bank. Commonwealth had assets of about $50 million, about half the size of the First National of Omaha, which had desired a merger for many years. Such a merger was prevented for personal reasons, but there was evidence that this situation would not continue indefinitely. Thus, we had a combination of one, very, very strong defensive characteristics, two, good solid value building up at a satisfactory pace, and three, evidence to the effect that eventually this value would be unlocked, though it might be 1 year or it might be 10 years from now. If the latter were true, the value would presumably have been built up to a considerably larger figure, say $250 per share. Why? Because he's adding that $10 per share of earnings and growing earnings to the book value, compounding over time over that 10-year period. Over a period of a year or so, we were successful in obtaining about 12% of the bank at a price averaging about $51 a share. Obviously, it was definitely to our advantage to have the stock remain in a dormant price. Our block of stock increased in value as its size grew, particularly after we became the second largest stockholder with sufficient voting power to warrant consultation on any merger proposal. Commonwealth only had about 300 share stockholders and probably averaged 2 trades or so per month. So you can understand why I say the activity of the stock market generally had very little effect on the price movement of some of our holdings. Unfortunately, we did run into some competition on buying, which rallied the price to about $65, where we were neither a buyer nor a seller. Very small buying orders can create price changes of this magnitude in an inactive stock, which explains the importance of not having any leakage regarding our portfolio holdings. In the late in the year, we were successful in finding a special situation where we could become the largest shareholder at an attractive price. So we sold our block of Commonwealth, obtaining $80 per share, although the quoted market was about 20% lower at the time. It is obvious that we could still be sitting with $50 stock patiently buying in dribs and drabs, and I would be quite happy with such a program, although our performance relative to the market last year would have looked poor. The year when a situation such as Commonwealth results in a realized profit is, to a great extent, fortuitous. Thus, our performance for any single year has serious limitations as a basis for estimating long-term results. However, I believe that a program for investing in such undervalued, well-protected securities offers the surest means for long-term profits in securities. I might mention that the buyer of the stock at $80 can expect to do quite well over the years. However, the relative undervaluation at $80 with an intrinsic value of $135 is quite different from a price of $50 with an intrinsic value of $125. And it seemed to me that our capital could be better employed in the situation which replaced it. This new situation is somewhat larger than Commonwealth and represents about 25% of the assets of the various partnerships. Very concentrated position, ladies and gentlemen. While the degree of undervaluation is no greater than in many other securities we own, or even than some, we are the largest stockholder, and this has substantial advantages many times in determining the length of time required to correct the undervaluation. In this particular holding, we are virtually assured of a performance better than the Dow Jones for the period we hold it. So a couple of things here. He's talking about opportunity cost. He couldn't get enough stock at a low price. He was a buyer up till about $65. He couldn't get any stock. Someone came in and offered him $80. He had a chance to take a nice gain of 60% and put it into a new position where he'd be the largest shareholder and he could influence management and get probably a better return than he would get from 80 to 135, holding it for much longer, and he would have more control. So it gives you some insight into Buffett's mentality in the early days about opportunity cost, about control, about ability to influence. And you're seeing him deal in some very illiquid stocks where he can have some level of influence.